There's more to this story than meets the eye. Everyone assumes precious metals automatically skyrocket when stocks collapse. But the actual data from real crashes tells a completely different story, one that the financial industry deliberately keeps murky because the truth does not sell their products. I've been through 3 major crashes as a trader, and each time I watch supposedly educated investors get absolutely destroyed because they believe the fairy tale about gold and silver being automatic safe havens. The 2008 financial crisis. Gold actually dropped 30% in the initial panic. The COVID crash in March 2020, silver got cut in half alongside the S&P 500. These aren't obscure facts buried in academic journals. They are documented price movements that somehow get memory hold every time the precious metal salesmen start their pitch about crash protection. Let me walk you through what actually happens when the stock market loses half its value, because the mechanics are fascinating and completely counterintuitive until you understand how institutional money really moves during a crisis. First, we need to establish what we're actually talking about when we say 50% stock market crash. This is not some theoretical exercise. The S&P 500 dropped 57% from October 2007 to March 2009 during the financial crisis. It fell 86% during the Great Depression. The Nasdaq crashed 78% from 2000 to 2002 during the dot-com bust. These catastrophic drawdowns happen with predictable regularity throughout market history, roughly every 15 to 20 years if you're tracking major structural collapses rather than routine bear markets. The assumption everyone makes goes something like this. Stocks crash, investors panic and flee to safety. Gold and silver represent the ultimate safety because they're real money. Therefore, precious metals must surge during equity crashes. It sounds perfectly logical. It follows a clear cause and effect chain. And it's wrong in ways that cost people millions during actual crash scenarios. Here's what actually happens during the initial phase of a major stock market collapse, and this is critical to understand because the timing makes all the difference. When stocks start falling hard, and I mean circuit breaker triggering, margin call inducing crashes, institutional investors and hedge funds don't immediately rotate into gold. They face a much more pressing problem. They need cash to meet margin calls and redemptions. Think about that for a second. When you're managing a $1 billion fund and stocks are down 20% in a week, your prime broker is calling every morning demanding you post more collateral. Your investors are panicking and submitting redemption requests. You're not thinking about which assets will perform well in 6 months. You are scrambling to raise liquid cash in the next 48 hours. What's remarkable about this is precious metals get sold alongside everything else during this initial panic phase because they're one of the few assets that can actually be converted to cash quickly. Try selling commercial real estate in a panic. Try liquidating a portfolio of municipal bonds when credit markets are frozen. But gold, silver, you can sell those 24 hours a day in massive size and get settled in cash within 2 business days. This is exactly what happened in September and October 2008 when Lehman Brothers collapsed. The data from that period reveals something the gold dealers absolutely hate to acknowledge. From March 2008 to October 2008, while the S&P 500 was dropping 40%, gold fell from $1,000 per ounce to $720, a 28% decline. Silver got massacred even worse, falling from $21 to $8.40, a stunning 60% crash. These weren't minor corrections. These were devastating losses that happened simultaneously with the stock market collapse everyone said would send precious metals to the moon. I remember watching this unfold in real time from the trading floor, and the cognitive dissonance was incredible. You had financial commentators on TV still parroting the gold is a safe haven narrative while the spot price was getting absolutely annihilated. The excuse-making was spectacular. It's just temporary liquidation. The fundamentals haven't changed. This is actually a buying opportunity. All of which may have been true, but it doesn't help you if you bought gold at $950 expecting it to protect you during the crash, and instead watched it drop 30% while your stock portfolio imploded simultaneously. What's fascinating is the relationship between stocks and precious metals during crashes operates in distinct phases, and understanding these phases is the difference between getting destroyed and actually positioning yourself correctly. Phase 1 is the liquidation cascade I just described. Everything gets sold. The correlations between asset classes that normally move independently all spike toward 1. 0, meaning everything falls together. This phase typically lasts anywhere from a few weeks to several months, depending on the severity and nature of the crash. During the 2008 financial crisis, this phase ran from September 2008 through November 2008. During the COVID crash, it was compressed into about 3 weeks in March 2020. Phase 2 begins when the Federal Reserve and central banks flood the system with liquidity. This is when the narrative about precious metals starts to actually play out. But notice the critical timing difference. But you had to endure that initial 30% drawdown while simultaneously watching your stock portfolio collapse. How many investors actually pulled that off psychologically? The ones who bought gold at $950, expecting immediate crash protection, either panic sold at $750 for a loss, or were so psychologically damaged by watching their safe haven drop 30% that they couldn't hold for the subsequent rally. Silver showed the same pattern, only with more extreme volatility. After bottoming at $8, $40 in November 2008, it rallied to $48 by 2011, an eye-watering 471% gain. But again, you had to survive that initial 60% collapse and have the psychological fortitude to hold through the darkest days of the financial crisis. This leads us to an important point. The people who actually make money on precious metals during stock market crashes aren't the ones who buy gold and silver as the crash is happening. They're the ones who already own it, understand the liquidation dynamics, have strong enough hands to not panic sell during phase 1, and recognize when phase 2 is beginning. Let's contrast this with what happens if you're looking at physical gold and silver versus paper gold and silver, because the dynamics actually differ in important ways. When I say paper gold and silver, I'm talking about GLD, SLV, gold futures, silver futures, mining stocks, anything that's not actual physical metal in your possession. During the 2008 crash, gold mining stocks got absolutely obliterated, far worse than gold itself. The GDX, which tracks major gold miners, fell 67% from March 2008 to November 2008. Gold fell 28%. Silver miners did even worse, with the GDXJ, junior gold miners, losing more than 70%. The reason? Mining stocks are equities. And during a crash, equity correlations all spike. Doesn't matter if you're mining gold or making widgets. If you're a stock, you're getting sold in a broad equity crash. The fundamentals of having gold reserves in the ground don't protect you when hedge funds are liquidating everything with a stock ticker. Physical metal showed slightly better resilience during the crashes I've tracked. And the data here gets interesting because premiums decouple from spot prices. During the March 2020 COVID crash, spot silver fell from $18 to $12, but try buying physical silver coins during that period. Dealers were charging $20 to $25 per ounce if they had any inventory at all. The premium over spot exploded to 100% because the refineries shut down, the supply chains froze, and demand from retail investors spiked massively. So you had this bizarre situation where paper silver crashed 33%, but physical silver became nearly impossible to buy. And when you could find it, the actual price you'd pay was higher than before the crash. This creates an interesting arbitrage scenario in theory, but in practice, it doesn't help you much. If you already owned physical silver, great. You didn't experience the full drawdown that paper silver showed, but you also couldn't really sell it for those premium prices because the dealers weren't buying at those levels, only selling. And if you were trying to buy physical silver as crash protection, you discovered that the supposed price crash wasn't real at the retail level. Think about that for a second. The asset that's supposed to protect you during crashes became simultaneously worth less on paper, but actually more expensive to acquire in physical form. The disconnect reveals how shallow the retail precious metals market really is. The total retail investment demand for physical gold and silver is tiny compared to the paper markets. So when you get a surge of buyers during a crisis, the physical market breaks down while paper prices keep trading based on institutional flows. Now let's talk about what happens to gold and silver if we get a genuine 50% stock market crash in the current environment. Because the setup today is different from 2008 or 2020 in some critical ways. The debt levels are higher. Federal debt has exploded from $10 trillion in 2008 to over $35 trillion now. Corporate debt has skyrocketed. Consumer debt is at all-time highs. This matters because when the next crisis hits, the Federal Reserve's response is essentially predetermined. They're going to print money on a scale that makes 2008 and 2020 look restrained. They have no choice. The debt loads are too large to allow a deflationary collapse. They'll flood the system with liquidity, which theoretically accelerates the timeline to phase 2 where precious metals rally. But here's where it gets tricky. The speed of the crash matters enormously. A slow-motion 50% crash over 18 months like 2008 plays out very differently from a rapid 50% crash over 2 months like we saw partially in 2020. The faster the crash, the more violent the liquidation phase, the worse the initial drawdown in precious metals, but also the faster the Federal Reserve response and the quicker the transition to phase 2. I've studied the correlations across different crash scenarios, and there's a pattern that emerges. In crashes that are primarily liquidity-driven, where the financial system is seizing up, and nobody can access cash, gold and silver get hit the hardest initially because they get sold alongside everything else to raise cash. The 2008 crash was this type. In crashes that are primarily valuation-driven, where stocks are just overvalued and correcting without a systemic financial breakdown, gold often holds up better or even rallies because there's no liquidity crisis forcing indiscriminate selling. The early 2000s bear market showed this pattern, where gold actually rallied while the Nasdaq collapsed. The next major crash, whenever it comes, will likely have elements of both. But I'd bet on it being more liquidity-driven, given how leveraged the entire system has become. Which means you should expect that initial liquidation phase where everything gets sold, including precious metals. What is remarkable about this is the very best time to buy gold and silver is actually during that liquidation phase of a crash, not before it and not after it. Before the crash, precious metals often trade at elevated prices because people are worried about the bubble in stocks and have already rotated to safety. After the liquidation phase ends and phase 2 begins, precious metals start rallying, so you've missed the bottom. But during that chaos, when gold is dropping alongside stocks and everyone is panicking, that's when you want to be buying. The problem, of course, is that buying during maximum fear requires either cold-blooded discipline or ignorance. Most people can't pull the trigger when everything is falling. The same psychological factors that make people buy stocks at tops make them unable to buy metals at bottoms. You're fighting every instinct that tells you to protect your capital and avoid catching falling knives. Let's look at specific price targets because this is what people actually want to know. If the stock market crashes 50% from current levels, where do gold and silver likely go? I can give you the ranges based on historical patterns, but understand these are probabilities, not certainties. Gold is currently around $2,700 per ounce. Until that pattern breaks, you should expect precious metals to follow the historical pattern of initial liquidation followed by recovery. Here's what you should take away from this. If you're buying gold and silver as crash protection, you need to understand that you're buying them for the phase 2 rally, not for phase 1 protection. You're accepting a potentially substantial drawdown in the initial panic in exchange for massive upside once the monetary floodgates open. You need enough cash reserves to meet any obligations during the crash without being forced to sell your metals at the bottom. And you need the psychological fortitude to hold through the initial liquidation, or better yet, the discipline to buy more when prices crash alongside stocks. The people who got wealthy from precious metals during past crashes weren't the ones who panicked into gold as stocks were falling. They were the ones who already understood this pattern, who bought during the maximum fear when gold was getting liquidated alongside stocks, and who held through the entire recovery knowing that the monetary response was inevitable. That's a very different strategy from treating gold as a simple panic button you hit when stocks start falling. I'll add one more critical piece that most people miss. Your time horizon matters enormously. If you might need to sell your precious metals within 6 to 12 months of buying them, you're taking massive timing risk around these crash cycles. You could easily buy before a crash, suffer through the liquidation phase, and be forced to sell before the phase 2 recovery happens. But if you're buying precious metals as 5 to 10-year portfolio diversification with the capital to hold through anything, then the crash dynamics matter less, because you'll eventually get the recovery rally regardless of when you bought. The worst possible approach is buying precious metals on leverage or with money you might need in the near term, then experiencing a crash and being forced to liquidate during phase 1. That's how people turn the best long-term asset class during monetary expansion into a devastating loss. I've seen it happen repeatedly to investors who didn't understand the mechanics. Final thought on the mining stocks because they deserve special mention. If the stock market crashes 50%, gold mining stocks will crash too, probably 50 to 70%, regardless of what happens to gold itself. Their stocks first, gold plays second. But the recovery in mining stocks once phase 2 begins can be absolutely explosive. 300%, 400%, sometimes 1,000% gains in the best companies. The leverage to gold prices is real, but you get negative leverage during crashes and positive leverage during recoveries. You need even stronger hands to hold mining stocks through a crash than to hold physical metal. What's fascinating is, despite all the data showing that precious metals get sold during initial crash phases, people keep making the same mistakes because the sales pitch is so compelling. Gold has been money for 5,000 years. Silver is real wealth. When paper assets fail, precious metals prevail. These statements are true over long time frames, but they're dangerously misleading over the short-term chaos of a crash. The precious metals industry profits from this confusion, selling people crash protection that doesn't actually protect during crashes, only after them. If you're positioning for a 50% stock market crash today, here's what I'd actually do rather than just panic buying gold. Keep 20-30% of your portfolio in cash or very short-term treasuries to deploy during the crash. Keep 10 to 20% in precious metals that you're prepared to hold through a potential 30-40% drawdown. Keep the rest diversified across assets that can survive a crash. Then when the crash actually happens and both stocks and metals are getting liquidated, you deploy that cash into both. Stocks at 50% off and metals at 30% off. That's how you actually capitalize on the crash, rather than just trying to hide from it. The investors who built generational wealth during 2008 weren't the ones hiding in gold before the crash. They were the ones with cash who bought everything during the panic, including gold when it dropped to $720. That's the reality that does not sell as many precious metals products, but actually works when you're living through the crisis rather than just theorizing about it from a position of safety. So yes, gold and silver can be valuable components of a crash-resistant portfolio, but not in the simplistic way they're marketed. They're not panic buttons. They're volatile assets that will likely get sold alongside stocks during the initial chaos, then rally massively during the monetary response.